China has been coming for at least a year to Mexico and Peru in particular. Now, Mexico's number one, China's number two, Peru's number three in production, but they've been going directly to the miners, disintermediating the marketplace, buying doré and concentrate. This is classic. This is called shaking the bushes. The big traders love this. They see, not only do they have a book where everyone is positioned, they know that who should not be playing in that sandbox. Where she says Trump will back the back end of the Treasury market July 4th of 2026 with gold. She's written a book about this. I've been talking about that for well over a year, Charlotte. Sean Kuhn, who I'm sure you know, the CEO of Dolly Varden, has told me a long time ago, and I've been reporting it for at least a year, that, everyone's fixated on Samsung going to Mexico to open up a mine that was closed to take all of their doré and concentrate for 2 years. Okay, fine. But Sean said to me well over a year ago, in fact, it was at dinner, I believe, at the Vancouver Resource Investment Conference, which is about a year from next week. And he said, or a year behind last week, you know what I'm getting at. Anyways, he said, yeah, China has been coming for at least a year to Mexico and Peru in particular. Now, Mexico's number one, China's number two, Peru's number three in production, but they've been going directly to the miners, disintermediating the marketplace, buying doré and concentrate. Doré are the bars that the miners will crudely refine, and I don't know to what percentage, but nowhere near full refining. And concentrate is a byproduct sludge of the mining process. They will pay double what the West will, disintermediate the market, ship it back to China, and refine it themselves. Now, this is the number two producer in the world, going to great lengths, flying to, South and Central America to do this, and to Mexico, building a deep water port in Peru, doing all of these things to be able to do this. And they're already the second largest producer. So this has been going on for a while. And I think it goes to show, if it's that important for China to buy silver in a pre-production, pre-refining stage, sending it all the way back and refining it in order to disintermediate the marketplace, I think it tells a signal just how valuable it is. And certainly, in my opinion, far more valuable than the dollars used to purchase it. So yeah, all of these pieces put together are far more important than looking at them individually. What you have is the second largest producer of silver in the world, who is basically saying that this is not a metal that is properly valued, that in order to have an advanced society, one that is electronic and digital and AI and a strong military and all of these things, that it's an asset that you need. And as we've documented for a long time, it's depleting. This will be the sixth year in a row of structural deficits of between 1 and 200 million ounces, if not more. And of the 800 plus million ounces mined, again, this last year, less than 200 million came from companies like Sean's that primarily mine silver. It's byproduct mining of copper, lead, and zinc, where the majority of the silver is coming from. So it's becoming harder and harder and harder to find it in large deposits. So it's no wonder that China is going to such great lengths. Samsung caught the headlines, which has been verified and validated a couple weeks ago, negotiating with a silver mine in China themselves. But yes, put it all together with being reclassified critical, export bans, and you can begin to see where this is leading if you take an objective assessment of it.
This is a critical supply chain shift that the news isn't covering. China is bypassing the open market completely to secure silver directly from the mines. This is a silent takeover of global inventory. If you want to stay ahead of these macro trends and protect your wealth, make sure to subscribe to our channel and turn on notifications now.
Yeah, I appreciate you taking all the little pieces and building them together into the whole. I think it's so important to take that step back and look at what's really happening. And as we have all this going on with the silver price demand, my impression is there are efforts to calm the market. So I want to talk to you as well about the CME Group margin increases. So what can you tell us about that? How can people understand what's going on there?
Well, you have to understand that the margin increases are something the CME has done for a long time in markets that rally, and it's specifically targeting the longs, specifically, which is kind of annoying. And so for people to understand what I mean by margin and margin increases, they did 2 margin increases in the last 2 or 3 weeks. The last one was the day after Christmas, on the 26th. Then on Christmas Day and before, you would have needed roughly $21,000 in your margin account to cover one 5,000 ounce silver contract. Put silver at $70. You know, you're controlling an awful lot, $350,000 worth of silver you're controlling with the $21,000 margin account. Okay, so they said, well, on the day after Christmas, we've just bumped it up 30%. So now you have to have $27,000 in your margin account. And if you don't post that into the margin account immediately, why then they liquidate it? And so everyone, let's say someone's on leverage and had to, bought 30 contracts on leverage, have enough, money in their margin account. And now all of a sudden they have to have 30% more in there. So they have to sell a whole bunch of these contracts in order to cover their margin. And selling begets selling. As the price falls and margin is increased, all of these traders on leverage get squeezed. Now, this is classic. This is called shaking the bushes. The big traders love this. They see, not only do they have a book where everyone is positioned, they know that who should not be playing in that sandbox. Now let's take a step back for a second. When we see in the first few days, 30 million ounces of silver delivered in the first 6 days, 18 or 19 in the first 3 days, 60 plus million delivered in December. These are the institutional or central bank, sovereign wealth fund, Teslas, Samsungs, Sonys. These are people that aren't using leverage and not using margin. I'll make it an easy to understand way. If you are looking at a home or a neighborhood in a gated community where the homes are 30, 40, 50 million dollars, do you think those people care what mortgage rates are? No, they don't. They come in and drop $50 million check, and it's probably their second home. The other one is up in, probably up in upstate New York in the Hamptons or whatnot. And so they don't care. But in a normal neighborhood where people are on mortgages, yeah, it's going to have a detrimental effect on the value of the homes, for sure, as mortgage rates go higher. Well, that's the same thing here. You get all of these traders who might be well-heeled, but not well-heeled enough to be playing in that sandbox, go in on leverage, taking advantage of the rising silver price, and then they jack up margins on a day after Christmas when most people are on vacation. They do this specifically to protect the shorts and for some stupid reason, but they do. And okay, so they do. They drive down the price. All these traders get squeezed. Silver drops. And who's sitting there? Thank you very much. Waiting to pick it up at subsidized prices. This would be the big traders who have been standing for delivery.
Did you catch that? He calls it shaking the bushes. The institutions raise margin requirements to artificially crash the paper price. They are trying to scare you out of your position so they can swoop in and buy your physical silver at a discount. Do not let them shake you out.
So, but what's interesting, Charlotte, in every market I can think of, go back to 2011, they did the same thing when silver hit 50, and then it took, what? It took 15 years to come back. But that's not happening anymore, because what's different about this market than anything I've ever seen in 35 years is the standing for delivery. These contracts in London and in New York have a delivery option, but no one ever did so. They would use it in terms as cash settlement or exchanging warrants back and forth. Paper promises, you own it, no, I own it, no, you own it, no, I own it, and with warrants. But now they're saying, yeah, no more paper, send me the real thing. And that is what is distorting and blowing up this scheme that they've used for so long, and they can't hold it down anymore. Yeah, it goes down. Today's the second day in a row that we've seen it down, and haven't seen a second day in a row in a long time. Normally it's one day down, one day or two, 3, 4 days up. This is a game that every single time that they hit the price, there are traders in Asia just sitting there waiting, or big institutional traders here in New York who are standing for delivery. And again, no one asking, who the hell is this? And that should be the only question. Who's doing this? Is it the Treasury in the Exchange Stabilization Fund? Is it because now it's critical? The U.S. government needs it. We're building a $7 billion smelter I mean, you can see the priorities are shifting, and at that level, the people who bring in billions of dollars worth of stuff don't do it for the hell of it. They do it because they've been instructed to, or they know where the playbook ends. All of this stuff in terms of margin hikes, which used to be the death knell of a rally, seem to be nothing more than a fairly significant speed bump. But you also have right now the rebalancing of the Bloomberg Commodity Index, where by law, and it starts today and it goes for the next week, all these funds that are way out of whack in terms of their balance, because silver and gold, for that matter, have outsized gains last year that have created a mess up with the equilibrium of the portfolio. So they will be forced to rebalance and sell and drive the price down. Silver's going to look like a heart rate monitor for the next week. But who's there waiting to pick it up? That's right. That's the Asians. And that's right. That's Samsung and Sony and whoever is standing for delivery here in this country. So it plays right in. But at the same time, you have the January effect, where all the hedge funds need to redeploy money. So the volatility will be fantastic over the next couple of weeks. But Bank of America just came out and said, we can see silver going as high as $309. Now you're beginning to see it from the mainstream, where companies and banks that were incredibly bearish on this stuff forever are now flipping the narrative. You got the chief investment officer of Morgan Stanley saying put 20% of your assets in gold and do that by selling half your bond exposure. You got the chief analyst for Bank of America, Michael Hartnett, saying no, make it 25%. You got Jeffrey Gundlach, the bond king, saying 25% of, and this is a guy who's made his reputation, living, and nickname by selling assets that have a return. 25%, he says, of assets in metals is not overvalued. So we're beginning to see at the highest level a change of mentality, a change of perception of what these metals truly are. And it hasn't really gotten down here yet, but you can see it with what's happening on the Comex and the LBMA, that we are in the midst of a change of, I think, perception and reality as to what gold and silver truly are.
This is the signal we have been waiting for. For decades, Wall Street ignored precious metals. Now, Bank of America and Morgan Stanley are telling clients to allocate up to 25% of their portfolio to gold. When the bears turn into bulls, you know the smart money is positioning for a massive move.
Definitely, it seems like real changes are happening right now. And I'm interested to talk a little bit more about the price, because I know that some people feel a little bit uncomfortable when they see more mainstream entities making these very high price predictions. I know that you're certainly bullish on silver. You mentioned we're going to see some volatility in the near term. What are your expectations for price in 2026?
You know, I hate making those guesses. I think $100 silver is something, you know, Keith Neumeyer made it famous years ago with his triple-digit silver shirt that he sent me for during Christmas maybe 4 or 5 years ago. And, you know, at the time people laughed about that, but he's not too far from being off. And in fact, if you could take a technical viewpoint of it and talk about a 45-year cup and handle formation that was broken. Now, a cup and handle formation in technical analysis is one of the most bullish formations you'll ever see, especially one that's 45 years long. So at the top in 1980, you had $50. At the bottom in the early 90s, you had $4. The difference from top to bottom is $46, right? So then you get back up to 2011, $50. It's rejected. That's the top of the cup. Then the handle comes down to where we were just recently when we broke through 50, and off it goes. Now, technical analysis would say you take the top, you take the bottom, which is 50 minus 4, 46, add it to the breakout, that's $96. Not too far from it. Now, at the same time, if you take right now the price of gold at $44.50 and divide by 45, well, you can see what that's going to be pretty easily. $44.50 divided by 45 is $99. 45 is pretty much the average price ratio we've seen for the last 100 years, and that's with central bank manipulation holding down the silver and gold price. Gold for Gibson's paradox, silver for the military-industrial complex. We can go down that road maybe when I see you in Vancouver what I mean by that. But the point of it is that whether you take the 100-year average, whether you take the breakout of the cup and handle, I think $100 is easy. But it's coming out of the ground at 7 to 1. So in terms of its geologic ratio, 44.50 divided by 7 is $635. As crazy as that sounds, I'm not saying it's going to get there, but put it in perspective when you see what Bank of America says. And they're using the gold-silver ratio as their barometer because they're saying $500 or $5,000 gold next year. So you take 5,000 and divide it by 45 and you get $111. Take 5,000 and, divide it by 35 where it got down to in 2011 and you're at 142. Look, all I'm saying is that we're still undervalued. There's still a long way to go by every metric, whether it be historical price averages in relationship to gold, geologic averages that go back 5,000 years, and really an asset that's never been allowed to find real price discovery. So yeah, I think we still have plenty of room to go. But Charlotte, I want it to be very clear, you don't buy the problem people made in 2021 with silver squeeze is that they bought it for the wrong reason. And I think they became disenchanted with its performance. You don't buy silver to become wealthy. You buy it because it is wealth. For 6,000 years, if you look at gold and silver, cumulatively mentioned over 700 times in the Bible, it's been wealth through 2 world wars, German hyperinflation, the Great Depression, every pandemic, everything. And history doesn't always repeat, but it sure as hell rhymes. And now you see the biggest money in the world, the most well-informed money in the world, whether it be the central banks, the commercial banks, the sovereign wealth funds, or now the institutional traders here in the United States that are showing you through delivery of both gold and silver just how important it is. And silver now being critical in both the European Union and the United States, prioritized in Asia. And if you watched any of the videos I've done with Judy Shelton, 2 of them, where she says Trump will back the back end of the Treasury market July 4th of 2026 with gold. She's written a book about this. She's all over the place saying this. She was his nominee for the Fed in 2016 and an advisor and on his transition team. You're beginning to see that gold seems to be, whether it be here in the United States, perhaps backing the long end of the bond market, or in Asia and the BRICS with a settlement vehicle to settle imbalances in trade or currency. Gold is finding a way to, I think, be reintegrated quietly into the monetary system, and silver is just...
This is the most explosive prediction of the entire interview. If Judy Shelton is right and the US Treasury moves to back bonds with gold in 2026, we are looking at a complete monetary reset. In that scenario, triple-digit silver isn't just possible, it is inevitable.
Being recognized as something you better damn well have or else, and that's what we see happening between very large sovereign nations, who many of which have a head start on us. So yeah, it's going to be an interesting year, and rather than pick a price, I say we live in a world of probabilities. The probability that we see silver well north of $100 to me is rather strong. Could it be as high as 200 or higher? Sure, but to say that would be a guess, and an optimistic guess. But look, if I would have told you last year that we would see silver at $80, you'd say, well, that's a pretty big statement, Andy. Yeah, sure it is. 150% gain in a year is pretty big. So rather than continue with that, I would just simply say higher than most people would actually probably think possible would be my answer.